Okay, so 1 minute. Okay, so the point that we had, so recapping what is there on the 21st. So the time, this may be a little too big, we'll find out. Okay, so one of the topics was time to expiration and vega. Okay, so longer dated options have higher vega. So if you get your eyeball view correct, the benefit, the secondary benefit, incidental benefit, let's call it an incidental benefit. An incidental benefit is the fact that you get a extra bang for your buck, because the longer dated option will have higher vega than if you had bought a shorter dated option. Okay, so now the other point, so this point is clear. Now the other point that we had discussed on the 21st, where we don't have the is position sizing. Actually, we can copy this. Yeah, we have discussed it. I'm just writing it since she's saying that there is no note for that, which is true, and then we don't have. Yeah. So we'll just briefly cover it. I'm not going to cover it in detail. Where did we go there?
Ultimately, that video was discussed with that part of the previous year's video. You can also share that.
Yeah, but then I'll have to find it. It'll take very few minutes. It will take like 5 to 7 minutes to cap it. Right? I'll just give you a brief outline, because the basic principles we have already covered. Okay, the basic principles we have already covered. So you are just going to apply the basic principles. I'm just going to give you this one. Okay, so this is the topic that is not there because the audio is not there on that. So position sizing on options. One sec. So let's. Okay, position sizing on options. This is a topic. Are you following what we are doing? We are just trying. This is what we discussed. Okay. So basically, there are two broad approaches to this position sizing. Okay. One. Some font size has become very big. Okay, so the first point is, the first way is that we what we do is assume option held to maturity, because we are talking about, so position sizing is based on risk. Okay, position sizing is based on risk assess. I mean, it's based on, as you can see, even this is what we did in our spot trading also. Remember when we talked about when we had to deal with that decision problem in our NSC trading project, when we had to deal with the decision problem of how do I decide how many shares to buy or how many shares to sell. Okay, so that we arrived at that is not an exogenous variable. That is an endogenous variable that is decided based on the entry price, the exit price, and the total risk that you can afford to take on each trade. Remember, we have all those calculations in our notes. Okay, the formula in our notes. Okay, what we have, how to arrive at those calculations. So so that's so that same principle that we are going to use there. So in any situation where we have, okay, this we can close now. Okay. I think recording should be on. Yeah, it's on. Okay. Let me open your. Okay, we have too many tabs on that one. So let's open your calc file, and we'll have. So we have different models for calculating that. Okay. So for calculating the position size, the same principle we are going to use here also in a position sizing for options. So the first, so there are two broad options to prove two broad alternatives. We won't use the word options here. So the first alternative is to assume that the option is going to be held to maturity and it's going to expire worthless. Okay. So why did I say it's based on risk? Because when we calculated our position size, even for spot trading, what was driving our calculations? Because remember, in one of the exogenous variables was the total dollar amount that we can afford to lose. Remember, here if you looked at some of your trade risk calculations, okay, the position size was coming out of the position size was being driven by the average risk per trade. Okay, this is the system edge. This is the average loss, okay, which is the average risk per trade. So when you are trying to figure out how much to buy, the answer to that is based on, this is the maximum amount that you can lose per trade, and then you take the entry price and the exit price, and then you, based on that, you figure out how many units you can afford to buy or sell. Okay, so therefore it shows you that position size is not something which is exogenously determined, which unfortunately even many professionals on trading desks just randomly decide how much to buy. Okay, it should actually come from a risk calculation. Okay, so the same principle is going to be applied. We are going to look at, let's say for our option trading program also, we have a maximum risk per trade of $41.6. okay, say 42k. We have 42k maximum risk allowable per trade. In this case, when we buy options, so when you're talking about position sizing for options, we are going to basically assume option held to maturity, and we are going to assume that it expires worthless. Okay, so in this case we will buy, okay, max amount to spend on premium equal to max loss per trade. Okay, so the max loss per trade comes from, remember you saw that our calculation earlier, not here, and you know how this number is derived, you remember that you basically make some assumptions about your trading system, what's going to happen, some ex ante calculations, any given period, quarter, month, year, 5 years, whatever it is. For that period you have to estimate number of trades, you have to estimate total percentage losing trades. Okay, that gives you a total number of losing trades. Okay, and then you have to look at your risk capital. What is your risk capital? You have 5 million of risk capital. Okay, so you should trade in a way, so you make the worst case assumption because you want to come out with some deterministic answers. Okay, remember deterministic versus probabilistic. When you do Monte Carlo simulation, the output is a probabilistic output, it's not a deterministic output. But probabilistic output is very risky because it's like there's a 5% chance of me dying, so I take the bungee jump, but then maybe I fall in that 5%. So we want to be in a situation where, you know, there is nothing worse can happen. We are already covering the worst case, so we want to go for deterministic kind of solutions. So we assume that if these assumptions are correct, number of trades, percentage losers. Okay, so therefore we take this total number of losers 135 plus 1. So we divide the total risk capital by 135 plus 1. Because why the plus 1? Because we assume all the losses are stacked together in the beginning. Okay, and then you should have money left over for one more trade, because if you're already bankrupt and zero, then you can't take any more trades. So you must have money left over. But if according to your calculations, there should be no more losses. So now it's all profits. Okay, so that's why this is how you arrive at this number. Okay, and this guides your position sizing eventually. Okay, it guides your position sizing. So therefore here what we are doing is we are connecting that maximum position size on options. 1 minute, I'll just finish this point. So is this first clear? Position sizing on option, the question that Tanya asked the other day, that what should be the total number of, or another way of asking is that what is the total amount I should spend on each option. Okay, so this is basically the position, or position sizing also related to amount to spend on premium. Okay, how much to spend on premium? The amount should be based on maximum loss per trade, so it should be equal to the maximum loss per trade. Is this clear? Okay, all right. So this is the amount that you, so here we are assuming, what we are assuming here is when we equate it to the maximum loss per trade, we are assuming that we are going to hold this option to maturity and it will expire worthless. Okay, why do we think like that? Because when we are doing risk planning, we always assume the worst case. We don't think about the good times, because the good times, we don't need to plan for the good times. Your planning is only for the bad times, right? So therefore we make this kind of assumption. This is one assumption. Yeah, what is your question, Anju? Maybe use the mic. Do we have the mic? Garvit? Mic on. Yeah.
So this is already been taught in session 10 in interval.
So then we are already done. I'll just quickly wrap it up. Okay, this is, yeah, so these basic principles were already taught. I'm just quickly recapping it, so just to refresh your ideas. Okay, and the second one is basically that which we don't want to do. Okay, we want to say follow okay, so is this clear? We say that you follow one above, and this, no, I'm just 1 minute, I'm just taking care of the fact that there are no notes, there is no audio for that day, okay? But the basic principles have already been covered, okay? And the reason I said that follow one above, don't follow number two, is because number two is basically assume, here again you will end up with some probabilistic kind of estimate. Assume that somewhere along the way you sell option is sold for some positive price, okay? Here you make sure, suppose you buy the option here, we have some options here, all right? Suppose I buy this option, maybe at 286 I buy the put, the 58.5 put I buy at 286. After maybe 3 weeks, or after, this is only 11 days left, after maybe 4 days, I feel that I no longer have the view to buy the put. I have surrendered my view, so I should get rid of my position. And I find that this put is trading in the market, maybe the bid is maybe 150. So then I can sell it off at 150. So my loss is only 286 minus 150. Okay, excluding the commissions. Okay. But the problem here with the second method, you can always estimate. You can assume that I lose 25%. If I lose 25% of the value, I'll cut it off. Okay, I'll square the position. But as I told you here, that here you can't actually, that 25% loss of your premium value has nothing to do with the market outlook. Remember that this, your views on options, to buy, call or sell put or whatever, is based on a view on the underlying and a view on the eyeball chart. Okay, so therefore your view to square off your position or to surrender your position or to cut the loss on your position should also be based on views on this. Are you following what I'm saying? So it should be true that either your underlying view or your eyeball view has changed. Now this need not correspond necessarily to some kind of arbitrarily decided percentage loss of your option value, option price. Are you following what I'm saying? That the fact that your option has lost 25% of the value need not have anything to do with the change in the outlook for the underlying or the change in the outlook for the implied call. So it's not logically consistent to approach the trading of options in that manner. Are you following what I'm saying? Right? So that's another, you can have an arbitrary cutoff. I'm just writing it for the sake of writing it. Assume this was sold for some price. So let's say plan to liquidate if option loses X percentage of value. Okay, so I can say this X, let the X be 40%. So if my option price drops by 40% from the time I bought it, if I have lost 40% on my premium outlay, then I will just randomly cut it off, I will just arbitrarily cut it off in the market, square it in the market. But the problem, this is not logically consistent. That's why I'm saying you follow one above. Okay, is everyone clear? But you should also be clear about what are the options available technically. This is one of the other alternatives available, but this is not logically very satisfying because it doesn't have anything to do with the change in the outlook based on the view on the underlying and the view on the eyeballs. Is this clear? Okay, Garvit, what are you looking at? Okay, look up, and everybody should be looking up and engaging with whatever's going on in the class. Okay. All right, so this takes care of your problem now, Anjum?
Yes.
Does it take care of your problem? Okay, we can move on to today's class, which is, we don't have much time, but we'll do it, whatever we can do, okay? So we are at positions versus synthetic, and so as I told you, figure 1.2, you will find at figure 1.2, you will find the long underlying and short underlying charts as well, okay? So we had done, we'll just quickly run through this, okay? Let's go through this, and which chapter is this? Which chapter is this? Which 12.2? 12.2. Okay. So we are in 12.1. Okay. So we have, this is yeah, so the entire figure is over here, so you can see. So please make sure you practice with, otherwise you will not be able to internalize all this stuff. Okay, so you can see here what is happening here, the dotted lines. Everyone can make out the dotted lines and the solid line. Okay, so the dotted lines are essentially the synthetic equivalent, and the solid line is the actual position that you're creating. Okay, so you can look at it the other way also. It's basically two equal, so these two dotted lines equal this. Okay, So you can see this here. This is actually the final profile. Let's go with what the sequence we have in the notes. Long underlying we have done. Short underlying we have already done. Short put. Okay. Short put. If you want to have a short put situation. Okay. This is your short put. First of all, short means there should be some part on the upper part, some positive. Short is showing you some option in premium inflow, so you have a positive part on the top. Okay, this is your premium inflow. Positive part on top means, a section on top above the zero line means there is some profit at some situation. This profit is the premium when there is no exercise. So short, this has to be some kind of short position. Now is it short call or short put? We can see that, but you are starting to lose money as the market falls below the strike price. So this must be a short put. Okay, so the short put can be recreated by, essentially you can, whenever you are thinking about this, you have to take it step by step, take it on either side of the strike price. Take it step by step. The first part is you got to create a situation where you keep losing money as the market drops. Okay, so one of the ways you do that is by taking the long stock position. If you take the long stock position, and whenever you're looking at underlying positions, the rate at which the underlying position is executed or entered into is to be taken as equal to the strike price. So the K is the strike price. We are discussing positions. We have 6 types of positions. Okay, long underlying, short underlying, plus the 4 option positions. Now we are playing around. We are taking each of those 6 positions and we are trying to create synthetic equivalents for those positions. Okay, so therefore now the question is, when you are looking at options, we know have strike prices and we are putting them at K. Now if we are looking at the underlying positions, long and short, then we have to assume that the price at which the underlying position is entered into, the short position or the long position, that is also at the strike price, which is K. Okay, you can see this here. So this here is actually, you see so here they are actually taken it as a little bit below K. Okay, they have taken it as a little bit below K, but we can work out the strike price based on the price and prices of the options of the call and puts. But for the sake of simplicity, you can assume it as the same as the strike price, okay, of the options. Okay, we take K as the same as the strike price of the options. Okay, so the basic idea is to get the profile. The basic here you want to create a profile where you lose money when the market falls below the strike. So you want to go long the underlying at the strike price. Okay, so if you go long the underlying means as the market drops below the strike, you lose money on the long underlying. Okay, but on the long underlying, because you're looking at a short put profile, you should actually get this kind of a short put profile where there is it should not be a continuously increasing profit on the other side, because if you just leave it at the long underlying, then what will happen is, following this dotted line, as the market rises above the strike price, you will continuously make profits. But that's not what you want. You want to create a profile where above the strike price there is a flat profile here, flat constant profit. Flat constant profit should be there, right? Are you following what we want to create? So you should understand the logic that what you are trying to create is this dotted solid line. You are trying to create the solid line, which is the short put profile. Is this clear?
Yes, sir.
Okay. So now you are trying to create this. The left hand side of it you have already created by going long the underlying. Okay. So you have created this, but now the problem is, if you are long the underlying, when it goes above the strike, you are constantly making money on the underlying as the market is going up. Now that's not what you want. You don't want a linear increasing profile like this. You want to cut it off. Here you want a kink in this curve here. You want to basically make sure that this part is constant here. Okay, so the way you do that, how can we do that? Are you following what the objective is? Going short what? If you go short the underlying, then what will happen is your long underlying and short underlying will cancel out completely, and then you will have no positions. You can't go short the underlying. You can't go short. You follow what I'm saying? If you go short the underlying, then the long underlying and the short underlying have completely cancelled. You have no position left. So you want to do something else to make sure that above the strike price, you don't have this continuously increasing profile. So what are you following what we are doing?
Yes, sir.
Make sure you follow step by step. Okay, what we are trying to do. This is clear? Okay, what happens, Surbi? You're not engaged in the class. You're looking down all the time. Are you following? So look at what is being taught on the board. Are you not feeling well? Okay. All right. Okay. So you want to basically make sure that we don't get this profile, because with the long stock position we are just getting as the market rises above the strike price, the profile is increasing, the profit profile is increasing in a linear fashion. We don't want that, because we want to basically create this kink and create a constant profit. It should not increase in a linear fashion along with the increase in the market price, right? So we have to find some way to eliminate this continuous upside which is happening, this proportional gain that is happening in the long stock position. We want to eliminate that somehow, so that we can actually end up with a flat constant profit. Are you following what has to be done, Aurora? Are you following the logic? Yeah, what we are trying to decompose how you construct synthetic equivalents, right? We are trying to construct the synthetic equivalent of a short put position, sorry. Okay, so one part we said is, okay, we want to go long the stock so that the left hand side of the profile will be taken care of. If a long stock, then market drops below the strike price, then we will continuously lose money in a linear fashion. That's fine. What about the right hand side of the profile? What can we do? Short what? What is your objective? Your objective is to eliminate the profit that is happening above as the market rises above the strike. One sec. Let's be very clear about what we are trying to do. We want to eliminate the profit that is happening in the long stock position as the market rises above the strike. We want to make sure that this linear increase in the profit profile because of the long stock position does not happen. We want to eliminate that. So, but we can't surrender the long stock position. We have to do something else so that it offsets. Yeah, who said short call? Yeah, so think about it. If you sell a call at the strike at the same price where you're long, what happens? If you're long a stock at 100 and you sell a call at 100, then all the upside above 100 you are essentially giving up. If you sell a call, let's say you're long stock at 100, okay, that is basically creating this profile where you're going, when you're long stock at 100, as the market price keeps on increasing, your profit keeps on increasing, okay? But you don't want that. You want to see when the market rises above the strike, you want to just cut it all off at a constant profit and just eliminate the remainder of the profit. This linear increase you want to eliminate. So one way you can do that is by selling a call. If you sell a call at the same strike at which you're long, essentially what will happen is, as your long stock position will make money as the market rises above the strike, but all the money you are making on the long stock position is all being eaten up by the short call. Because the short call means when the market goes to say 140.
Sir, if we will be buying the short call, sir, we will not be using any time.
How can you buy the short call?
Sorry, sir. If we will be buying the option that you said. Sir,
No. 1 minute. I said short call.
Yes.
Pulkit said short call.
Yes, sir.
So
sir,
you can't buy a short call.
Yes, sir.
You can't buy a short call. Either you go short the call or you go long the call. You can't buy a short call. You can say execute a short call.
Also, then we will not be losing any, sir, as you told that we will not be losing timing value. So you are saying the graph should go like
No, this is, now we are not talking about time value. These are expiration diagrams. These are expiration diagrams, so there is no time value left. Okay, we are talking about expiration diagrams. This is a scenario analysis at expiration, where K is the strike price. Let me do the plotting for, plot the chart for, okay, what if the market price is here? What if the market price is here? What if it is here? What if it is here? What if it is here? We are doing a scenario analysis at expiration. So there is no time value left here. Is this clear to everyone? These are expiration diagrams. No time value left. Okay? These are scenario analysis at expiration. We are just considering. So if you sell a call at the same price at which you're long, what will happen? Let's say you're long stock at 100, and the expiration one scenario is the market price is 150. So on the long stock you have made $50. Yeah, on the long stock you have made $50, but on the short call you have lost $50 in terms of payoff, not in terms of profit, but in terms of payoff, because you made some money by selling the short. You're going short the call. You've collected some premium. So we're not talking about profit. We're talking about payoff. But in terms of payoff of the short call payoff will be minus 50, because you have sold a call at 100 and the market price is 150. So the owner's payoff is plus 50. So your seller's payoff is minus 50. Are you following? Is everyone following? Yes. Gulati, what happened? You're not feeling well. Not feeling? Then you go. Why are you staying here? I'm not forcing you to stay here. You're not looking well also. Why don't you have any other class after this? Then go home. You're not looking well. I didn't even see. I thought you were just. You're not looking well, so I think you should go home. What happened? Go. You're not looking well also, so I think you should go. You can go. I'm saying you can go now. If you're not looking well also. Why don't you go now? What is the point of waiting for 15 minutes? It's not going to make your I'm not going to cut your attendance. You can go now. If you're not feeling, since you're not feeling well, you should leave now. Okay. Are you guys following? 1 minute. We are going through this we are going through this all step by step, each of these, but I want to make sure that you understand, because if you understand all the stepwise logic, it will strengthen your understanding of options. Okay, so is this clear? Okay, 1 minute, 1 sec. She is going now. Okay, there's a constant parade of people. Yeah, because nowadays in the CAT, you know that in the CAT, how long is the CAT now? 3 hours. You're not allowed to take any toilet breaks during the CAT. You know that. So, but I noticed that in the class you're always going out. If one person comes out, another person goes out. Okay, so all right. So is this clear now? The first one, we are dissecting the first one. We want to make sure that everybody understands. Everybody has to understand. If you don't follow at any step, Aurora, what is happening? You're looking down. Are you following what is being discussed? Yeah, you're trying to, but if you don't follow, then you have to interrupt me at any point of time. Okay, I've told you the questioning aspect does not change. You're still required to ask questions.
In this case, sir, there will be some assumptions also.
What assumption?
Sir, how will be, sir? I am not able to understand how will this line go straight.
1 minute. Which line? This one?
Yes, sir. Yes, sir.
Okay.
Why will this go straight?
Okay. Now this line here, why does it go straight? Because this is remember, this line is the result. This is the consequence.
So
1 minute.
This means that the price of which we got long on and short on will change in the same position.
No, 1 minute. Let me explain it once again, then you try to understand. Okay. Don't worry about the magnitudes of the lines, because we are talking about an example where, to make it simple, we are talking about going long and short. Okay, here they have gone long and short, the underlying at a different strike. Okay, so here we are assuming that we are going long and short at the same strike as the option strikes. Okay, so don't worry about the magnitude of the positive amount, but look at just the positive. Okay, so first try to understand this. Yeah, sorry, what you had a question? Tanya had a question. Yeah.
Which position? For which
Use the mic if you can. Yeah.
So for which position are we making a synthetic position?
We are saying that we need to create a short put profile.
Synthetic profile for short put.
Yeah, we want to synthetically create on the one hand we have the short put. Now we are trying to synthetically create a short put payoff profile by using combinations of other options and underlying. Okay, is this clear? That's the goal. Yes. So the way we do it is always disaggregated into two parts, left side and left and right side of the strike. Okay, disaggregate into two parts. The left side, we said, what do we want? We want a profile where the line is going as soon as when the market stops. So what is the profile of a short put? When the market drops below the strike, you start losing money in a linear fashion. Okay, so we want to create that profile on the left hand side. So the way we do it on the left hand side is basically we go long the stock. So that will ensure that as the market drops below the strike, we keep on losing money in a linear fashion. Is this clear? Because if you have a long stock position, as you can see here, when you have a long stock position, you see the independent long stock position. When you have a long stock position, as the market drops below the price at which you're long, you're continuously losing money in a linear fashion. Okay, you're long at 100, market drops to 40, you are losing minus 60. Okay, so on and so forth. You're losing 60 basically. So this is clear. Okay, so what we are doing is the left hand side of the situation we have created by taking a long stock position. But now the problem of the long, look at the other side of the story with the same position that you have taken. The first part you have taken is a long stock. The problem with the long stock position is that when the market rises above the strike, the long stock position is making money in a linear fashion, and it's creating the basically long stock position. At the moment you have only got a long stock, you haven't taken the next part, so you got this kind of profile. This is not good enough for you, because what you want is this kind of profile. You want this dotted, the solid line. You want to create this solid line. Left side is okay, but the right side is not. You need to at some point you need to start eliminating the profit, and this linear increase should not be there. So the way you do that is by selling a call. You have to think of what should I do to ensure that as the market rises above the strike, I keep losing money in a linear fashion. Because what are you trying to eliminate? You are trying to eliminate this phenomenon where you're making money in a linear fashion. You want to get rid of making money in a linear fashion. The way you get rid of that is by you make sure you lose money in a linear fashion, right? If you want to get rid of the situation of making money in a linear fashion, you do something to ensure that you lose money in a linear fashion. That will eliminate that profit. Okay, so therefore what you do, and how do you lose money? By using, this time you think about options, you go short a call. If you go short a call, you have this kind of situation. What is this? You see the short call. As the market rises above the strike, the call is continuously losing money, and so this continuously making money on the long stock gets totally eliminated by continuously making money on the this continuously making money, continuously losing money. So all the excess profit is wiped out above the strike. Is this clear? And you are left with, as I said, don't worry about the magnitude, because that is, we have assumed different rates at which you are long the underlying. Just look at here also, you have a long, you look at it, the fact that it's above the zero line, so it's a profit. Okay, so this profit, basically this profit comes from the profit. Remember, you're going short a call. So while you lose money above the strike price, you will be getting some upfront premium. That's your profit in a situation, and that situation is basically where it's when the market is below the strike, the call is not exercised, so it proportionately reduces the loss that you have on your long stock position. Okay, so therefore you see the situation here on this. So you can see from the short call, which gives you a premium outlay, just focus on the fact that it's above the strike. So are you following the thinking that needs to go in?
Yes, sir.
That on the one hand, you have been told some position, long underlying, short call, whatever, some position is given to you. Now you have to create the synthetic equivalent of that using some other combination of options and long underlyings, long, short, whatever. Okay, so first you should draw the position that you're trying to recreate. Now let's do this. What kind of position is this? The black line. What is the black line? We'll do it one more time. What is the black line? Yes, I'm getting long. Yeah, long put. It's a long position. Straight away you can see it's a long position because the black line is below the zero line, so there's a part where there's a constant loss, so that must mean the loss from the premium payment. Okay, and there's no exercise, so it's obviously a long position. Now question is whether long call or long put. Okay, so this must be a long put because it shows that you're making money in a linear fashion as the market drops below the strike. Yes. Okay, so therefore this must be a long put. So now you know that on the one side you have the long put. Now you have to recreate the profile of a long put. Again, go left side, right side, one by one. Left side, how do you create a profile situation where you want to see a situation where above the strike you're making money in a linear fashion. I'm sorry, not above this. As the market drops below the strike, you should make money in a linear fashion. Okay, how do you do that? You go short stock. Okay, if you go short stock, you can see you have this kind of profile. which you see here, short stock. This is short futures, okay, same thing, short underlying, linear instruments, futures, stock, spot instruments, stock, okay. Short stock will have this kind of profile, so this takes care of the left side of what you're trying to generate. As the market drops below the strike, you're making money in a linear fashion, okay. So this has taken care of the left side, but now we have to take care of the right side. What do we want on the right side? We want to have a constant loss. We can have a constant loss. Now, what is the short stock producing? The short stock, when the market goes above the strike, let's just stick with the first position that we took, okay, the first component of the synthetic. The short stock is continuously losing money in a linear fashion, okay, losses proportionately increasing as the market goes above the strike. We don't want that. We want some loss, but we want it to be capped at a certain level, okay. So what do we do? Okay, so we go long the call, okay. The long the call means we will have some kind of loss, okay, because we will have to pay the premium, okay, so that will keep us below the zero line, okay. And what is the other benefit of the long call? As the market drops below the strike, as the market goes above the strike, the call is continuously making money in a linear fashion, and the long call position is basically offsetting the short stock position, okay. The linear loss of money on the short stock completely offset by the money on the long call position. Is this clear? Yes, following? Are you following? Ritesh, are you following? Okay. Okay, so this is done now. Now you're getting this. You must make sure that you go back and revise all this, okay, one by one, stepwise, okay, don't gloss over anything. Okay, similar question to what Parul was asking the other day. Why do we bother with this? This you'll understand when you get to arbitrage. That because you can look at, okay, you can read the book by Nattenberg, the section that I've referred to. If you read that, you'll get some better idea. But the point is basically that in the market, sometimes you'll see, let's say you have this situation, okay. Sometimes you may see that the cost of going, we have gone down actually. So let's look at something we have already done. We have done this long put situation. Now the long put has a certain cost associated with it, in the sense you have to pay the premium, and you have to also look at funding cost of the premium, okay, given the interest rate and all that. So there is some cost, okay, of going long the put. But since you can also create a long put profile by doing these other two transactions, okay. So on the one hand, you have the explicit market cost of going long the put, okay. So you can look at a situation like this, and you can see that buying the 58.5 put, okay, is costing you 2.88, okay. Now, but you may find that actually going long the call, okay, and going short the stock, okay, or short the underlying, the combined cost of long the call and short the stock is less than 2.88, okay. In this case, what you will do is, since the two positions are the same, so the logic is basically that something cannot have can't have the same price, okay. So the same thing cannot have two different prices, okay. So therefore, what you will do is you will sell, let's say it's less than 2.88. The short stock and the long call together is less than 2.88, okay. And here, so therefore, what you will do, you will sell. This is, of course, you can't sell at this price. You have to buy. If you want to sell, it's 280. But let's assume that it's the same price, okay. This, by the way, is called a choice price. That also you should learn, that there is something in market making. We have bids and offers, okay. Sometimes the market maker will quote you a price which is just basically one price, and he will say CH after that, choice, okay. CH is for choice. Yes. So that means that that's just one price. That's considered a very good price. I'm giving you one price. At this price you can buy or you can sell, whatever. So if it gives you one price with a CH after that, that means it's a choice price, which means it's your choice. You can either buy or sell, okay. And so the market ethics is that if somebody shows you a choice price, this is when you're dealing in OTC markets, which we'll come to. The convention in the market is, when somebody is quoting you a choice price, you should never decline that price, because you have asked somebody for a price, okay. You should not just ask frivolously. If you're asking for a dealing price, you should be serious, ready to deal. And somebody quotes you a choice price, you should not decline that price. You should deal on that price. Otherwise, it's considered unethical, okay. I mean, basically unprofessional to not deal on a choice price. Okay, so is this clear? So good question again, same question that Parul was asking. What is the point? The point is basically because sometimes you may see situations in efficient markets. It's difficult to see them, but it is possible. This is what arbitrageurs do. Remember, we had a third category of market participant, okay, which you will find in your textbook also. There's some discussion of that. So arbitrageurs, this is what they do. They look for situations where the same thing, essentially, okay, the synthetic equivalent of something and that something itself, they are trading at two different prices. So there is an opportunity to earn an arbitrage profit. Here what they'll do is they'll sell the 288 put, okay, and they will go short the stock and buy a call, and the total cost of the short stock and long call will be less than 288. So that balance they will pocket and they'll have no risk, because remember the profile is the same, okay, the profile is the same. So if you're just looking at one side, if I have short something and I have a long call, basically I have no net exposure, because the long call is going to cover for my losses on the short stock, okay. So therefore you have no net risk, and so that's why we worry about these things. That's why we worry about these synthetic equivalent relationships, because in the markets you may find those situations prevailing, and so you should know what is the synthetic equivalent of what.
Isn't this hedging?
You could say it's hedging in the sense that once you sell the, you could say this is, once you sell this, once you sell the 285 call, which the put, which is too expensive compared to the synthetic equivalent price, okay, and then you buy this, it's, you could say it's hedging, but it's not a very good term, because hedging, we have a different category of people who are hedgers, okay. So hedging has, this is really more arbitrage, okay. This is called, because it's simultaneous, okay. So hedging, problem with hedging, using a term like hedging is, hedging can sometimes happen where in hedging you have to look at the concept of underlying position, okay, underlying position and the hedge position. Now the underlying position can remain in place. The underlying position can remain in place for quite some time without any hedge. So the hedge position need not always come into place at the same time that the underlying position comes into play. That's why we don't want to use the word hedging here, because here this is a case of arbitrage. So Ritesh, just shut the door, even whatever time we have, just shut the door. We don't want even 2 minutes. Okay, is this clear to everyone?
Yes.
I'll just quickly wrap up, okay. I'll just quickly wrap up here so that we can go on to the next topic in the next class, okay, which is what are we trying to create? Any question? Yeah.
How frequent this happens? Like it in the frequent thing.
How frequently do the prices go out of line?
No, the synthetic equivalent.
Yeah, that's what I was saying, that how frequently is the price of the synthetic equivalent different from the price of the other thing for which we are looking at the synthetic equivalent. So this, I can't give you a clear-cut answer to this because we don't know. It may happen. That's why arbitrageurs exist. Okay, they are always looking at synthetic equivalents versus the actual thing. Okay, so therefore, but it's impossible to answer your question that how frequently it happens, in the sense that how frequently does the sun rise every 24 hours. I can give you a clear answer. Here I can't give you a clear, because it depends on the market. Okay, but sometimes it happens, and that's when arbitrageurs come in. Okay. All right, so we have 1 minute. We'll try to finish something here at least. Quickly, I'll just wrap it up quickly. You can understand it later on your own. Okay, we are trying to create, what is this position here? Black line. Long call. The black line is a long call. Below this, rising above, profit rising above the strike, long call. The black line, this is your profile, figure number 2.1, figure 12.1 in your textbook. Okay, you can read this again and follow it up. Okay, long call, and then you can see, I'll just take 2 minutes extra, Garvit, okay, with your permission. Long call, we want to create a long call. Left side, we want to have a situation where everything cancels out, there's only a small loss. Okay, so we can buy a put which will make money above as the market falls below the strike, and we can offset that with a long stock position. So below the strike we'll have a constant loss, small loss, because on the long stock position we'll lose money as the market drops below the strike. Okay.
Yes, sir.
And on the long put we will make a corresponding amount of proportional profit. So the losses on the long stock position below the strike will be made up by the gains on the long put position. Is clear? Okay. So are you following? We have to figure it out this way.
Yes.
Okay. Now on the other side we want to have a constant profit. We want to have a proportionately increasing profit, linear profit profile above the strike. For that we have the long stock. because the long put will just have a constant loss and the long stock will continuously make money as the market goes up. Are you following? And the last one, you can manage it on yourself, on your own. I think you can manage. The last one is, what is this profile, the black line? Yes, short call. Okay, short call. First ask yourself, what can I do to create this constant loss, to linear loss profile above the strike? I go short the stock, okay, and then, but on the other side, the short stock will continuously lose money, will make money. That I don't want. I want to cut it off, okay. So then I go short the put will offset this. This is clear? So this topic is over. Next class we'll go on to historical volatility, not historic.
In every case, we are doing the same thing for the other two sectors. We are either longing it or shorting it.
Don't say longing it.
We are longing it or shorting.
We are going short or going long. Don't say longing it. No, we are not doing the same thing. We are not doing the same thing. We are asking the same kind of question. Don't say we are doing the same thing, because you are not actually doing the same thing all the time. You are asking the same kind of question. That is, what do I need to eliminate this profile and get what kind of profile, get the profile that I want. Are you following? Yeah?